if we construct portfolios like the one for Del Park, maybe you can give a little bit of context.
Yeah. In general, for the most part, we're not developing strategies. We're not issuing our own funds. What we do is we conduct the financial engineering for other firms and other funds to create portfolios for them and performance for them that make them perform optimally. So in this case, we did the financial engineering work for Daltot Capital. We created a growth portfolio with a 5-year lockup designed for people with a 5-year horizon or more, and a fixed income portfolio, which is packaged as a fixed annuity alternative, again, with a 5-year horizon. And took the asset managers that we have, which we just went through quite a few of them, organizing them, constructing portfolios with them in a way to optimize performance. And this is what the aggregate performance of the portfolios that we constructed for Daltot look like. So again, most people like to look at the future. They like to ignore the past. What we're doing is we're saying, all right, historically, this is what these portfolios did or would have done from 2007. So if you had invested in these portfolios on January 1, 2007 through the end of the year of 2023, and you had $15 million total, let's just say, I'll take a second and highlight that. So in terms of how to construct a portfolio for yourself, you really only need to know 4 things. The financial engineer only really needs to know 4 things. How much you're investing in total? What is your time horizon? And that means, and how much time do you need your principal returned to you? When do you need your $15 million back? During that period, how much income do you need? Do you need to live off of that? How much income do you need from your investments? And then finally, how much cash do you need to keep on hand for the duration of your time horizon, in addition to your income for big purchases, right? So you can think about it this way, right? Like I need X amount of dollars per month to eat and pay my car payment or do whatever, but I want to buy a boat. And so I need an extra X number of dollars to go buy a boat in addition to what my income would pay, assuming I'm not going to finance it or whatever. So in this case, we're looking at a sample scenario where the mandate we've given is $15 million to invest total. They need their principal back in 5 years. They need $90,000 per quarter. That's $30,000 per month to cover their lifestyle, their living expenses, whatever. And they need $1 million in the bank for whatever, emergency, feel good money, buy a house, car, boat, whatever. This is how the algorithm would break down the portfolio. First of all, it would say, all right, you told me you need $1 million in cash. That's going to sit in cash, $1 million, check. You said you need $90,000 a year in income. That's $90,000 a quarter in income. That's $360,000 a year in income. To generate that with our annuity product the annuity alternative that generates 8% per year, effectively guaranteed, which means it's underwritten across 2008 to ensure the dividend's going to be paid. That means you need to invest $4.5 million in the fixed income pot, the fixed annuity alternative, to generate that $360,000 a year, the income you need. And then what's left over goes into growth. That's $9.5 million. And so if you had done that in 2007, this is what your portfolio would have looked like. First of all, you'd have gotten $360,000 a year in income. Oh, by the way, there's a 2% kicker every 5 years that's designed to be an inflation offset. So what that means is every 5 years, you get an additional 2% is added to the previous 5 simple interest. So that's $810,000 a year in the year, every 50 year. Now, you could reinvest that, which would compound your income. Didn't do that here. Just saying you take it, right? Of course, your $1 million just sits in cash, and then not accounting for any nominal money market gains, because those are pretty nominal. And then on the growth, your $9.5 million at the end of your 5-year horizon turned into $30 million. You over tripled your money in 5 years. Oh, and by the way, if you held it the whole time since then, your $9.5 million over that period, about 15 years, is turned into $400 million. So this isn't pro forma. This is what would have happened given the past performance if the money was allocated then. So we take that past performance and we say, okay, what's happened across a full market cycle? We've seen the good, we've seen the bad of 2008. We average all that together. We'll say it's a reasonable expectation to generate 25% returns a year going forward. So this is where the pro forma comes in. It's just an average of what we actually experienced across a full market cycle historically. And so if you invested that same 9.5 in growth then, now you'd exit in 5 years or at the end of 2023 to the end of 2028. That 9.5 would turn into 28.5 million. You still get your $360,000 a year in income with the close to over $400,000 kicker at the end of year 5. And your total assets grew from 15 million to 35 million over 5 years. So your assets grew from 15 million to 35. You over double it. Oh, and by the way, you were taking out $360,000 a year of income. And this annuity alternative that we designed with capital gain tax liability as opposed to ordinary income as well. And that doesn't even include the tax advantage solutions that your CPA can design for you if he's competent. This is an example of what the quantitative finance expertise, the financial engineering expertise looks like from the grassroots. We applied it to individual strategies. We found the best strategies possible. We optimized their performance. And then we designed investment products securitizing those strategies for other asset managers like Daltok. And so this is what you can get. And so if you compare it to the S&P 500, it looks incredible. In other words, unbelievable. And if that's your paradigm, I understand. But that's not.
It's not always what we do.
It's when you compare it to Renaissance, it is expected.
Yeah, and it's not even that far if you consider the 5 and 44% that they're charging. We're pretty close to their net returns. And then what I just wanted to say is this could obviously also be like bespoke solutions that we do for family offices. If somebody is like whatever, like $500 million, and they say, okay, this is what we need in terms of income. This is what we target in terms of growth. It could be a bespoke scenario instead of a partnership like with Deltalk. Obviously, through the Redwood family office is what you are there to do. And then for the retail space, obviously, we're just trying to make this available through companies like Deltalk. But the work is basically the same, right? If you're looking at a family office, if they would get away from this idea of, okay, so we have to put that much money into that asset class and that much money into that asset class, and they would just basically go and say, okay, we just want to optimize for maximum growth with the money that we can lock up for 5 years or more, and then we need a certain amount of income. That's obviously, the engineering that you would bring in, right, and make that happen in combination also with having the asset managers at hand to basically create that performance. If you want to see how a portfolio could look for you, for yourself, go to the adagiogroup.com and just punch in /Q. That will bring you to a form where you can basically just answer those questions that Ben just mentioned with the total investable amount of money, some quarterly income that you would like to see, cash reserve requirements, and the time horizon. And then you will basically get a proposal created that would fit your needs. So I think we can head into the weekend.